Welcome to Financial Freedom APSL Investment for Beginners event. I'm Sanjay Kuridoku, as you all may know. So what we have been discussing so far in our previous sessions has been like what we can do with our hard-earned money. We have the choice of keeping it safe under a mattress, lending it to a bank, and maybe earning interest on it. We can also lend it to a company or the government, government bonds and things like that, in those sort of things, which earns us a reasonable interest rate. But in the current context, like interest rates being low and inflation being high, we have initially like indicated like these are not very good savings. Keeping the money in cash under a mattress or putting it into a bank is not the greatest alternative for investment these days. So we have been looking at investing in businesses such as the stock market, and we have focused deeply on investing in the stock market using ETFs and index funds. So like in the past sessions, that's what we have been speaking about. Here, like today, I'm going to talk a little bit about investing in individual shares and stocks, because like there has been quite a lot of indication saying that people would like to hear like how to, I mean, interest in investing in ETFs and index funds is great, but it's boring. We want to know a bit more how to invest in stocks and shares individually. So investing in individual stocks and shares is not for everyone. It can be quite risky, and it's like running through a dynamite factory with a burning light. You might live to tell the tale, but nevertheless, it's a very silly thing to do. So investing in individual stocks without knowing what you're doing can be a very dangerous game. So pay attention, and we'll be looking at some of the tools we can use in order to value stocks and shares. So before we get into the details of that, some warnings, the usual caveats of figures refers to the past, and the past performance is not a reliable indicator. Investment value can go up as well as down, or down as well as up. So none of us participating or giving our views are professional or qualified financial advisors. We can't give recommendations, and we are not financial advisors. If you need specific financial advice, you need to consult an independent financial advisor who will be able to give tailored advice that will suit your circumstance. Having said that, let's look at the stock market. Well, I wanted to pick up a stock and sort of elaborate what whether we can figure out a value of a stock. So here I have taken market performance of Amazon within the last 1 year. So if you can see my my cursor, this is like indicating. I've just taken this from the Google Finance website, and the stock is currently valued at $3,341 US. But you can see within the last year, the stock has gone up by 6.5%. That's from starting here to where it is now. But if you look at like September 2020, where it was at the lowest point, very soon from 3,000 to 3,400, this is a big increase. And these sort of increases has happened continuously. So if you think about this stock, Amazon has like, if we say like from the starting point, the lowest point here to the highest point in July 2021, the stock went to US dollars 3,000, close to 3,800. The increase is about 26%. But if you look at the value of the company, if you consider what has happened within the Amazon as an organization or a business, there hasn't been a 26% increase in sales. Their sales has not increased by 26%. Nothing else detrimental has reduced by 26% as well. But stocks keeps fluctuating. Like you will see within a month, sometimes it would increase or reduce. We can quickly jump into the live website showing Amazon. So you can see from this lowest point, if I move my cursor, here to here, the top point. So it's within a span of probably a month, 18th of September to 13th of October, the stock has increased about 16%. So do we think like Amazon stock, Amazon company performance or their sales increased in that month by 16%? So another point here, if you just look at like this lowest point here to the highest point, say here, again another 17%. So March to May, do you think like anything significantly happened in the performance of the company as Amazon? The answer probably would be no, not that much. What we have to disseminate is like stock can fluctuate hugely over a period of time, and that can happen due to various reasons. You might even say like, okay, I have picked up a company that is very volatile. So if we drop Amazon, and if you look at a different company, let's look at the Legal and General one. Okay, so within Legal and General, within the 5 years, you can see if you take a point here, I'm just showing you on the Google Finance website. So you can click on this mouse and move your cursor to the next point while you're right clicking your cursor. The dialog box shows like the movement. So in this small bit of time, the stock has increased 28%. At the previous point, it was 26%, 24% here. So like you can see the point I'm trying to make is within a small span of time, now in this point, from 23rd of August 2019 to 21st of February 2020, the stock has increased nearly 41, 42%. But if you look at, like if you really have followed Legal and General, the stock or the company has not done anything significant within that short span of time. So the thing is, what we need to understand is stock will move up and down based on the information that is being provided to the market, but it doesn't necessarily mean the company's performance or the company's value has significantly altered in real terms. The company will continue to perform in a certain way, but the interpretation by the market based on the information that is provided to the market, people's reaction will create prices to fluctuate high and low. And at most of time, the market, we call it the Mr. Market, the market sometimes overreacts. When there is good news, it overreacts. And that overreaction happens because there is an influx of people reacting to the same information at the same time. So I'll go back to my presentation. I mean, we've talked about Legal and General. I just wanted to basically make a very small point to say like prices in the market will fluctuate up and down, not necessarily meaning that the underlying company's performance or the value has changed much. You will obviously understand company's sales or company's profits wouldn't change that much over a long period of time. Yeah. So this is like, I mean, there is a, when we are learning financial market in school, we have heard this term saying like the Western or the US markets, or Western or developed markets, are efficient. But that's because when the market participants are assumed to be very intelligent, they are like full of information, they know exactly what is happening, and the market information is quite live. So the smart people, if the price is too high, what the smart people will do is they'll go and sell their stock, bringing the prices down. And if the price is too low, these smart people will go and buy the stock, eventually creating a market equilibrium. So it is assumed the markets are efficient. But from the example I showed you from Amazon and Legal and General, you can see the efficient market hypothesis is not always there. In the long run, it would, but in the short run, there are fluctuations up and down. Yeah. And then sometimes the stock market, sometimes greed is ruling. That means like people are, have you heard the term FOMO, fear of missing out? Or like because of fear of missing out, when like, I mean, there was some madness about GameStop and AMC theater stocks in a very unrealistic way. These prices were going up, and what people did was at the time went and bought these stocks because there was a hype, the prices increasing, and at some point some people will be buying at the market top, and then the market crash, the price crashes, and they would lose a lot of money. So this is the dangers in individual stock investment. But when greed is there, when people are reacting with greed in mind, then the prices starts going up. And when people are reacting in fear, prices come down. You might have realized like what happened when we first heard, or when we initially got a bit concerned about the illness, the pandemic, in March 2020, after February, just after February 2020, around March, the market crashed really deeply. And so that if you think about individual stocks that was in the market at the time, nothing has happened. It just people out of fear thought like things will be really bad, and people exited the market, put their money in safe havens, and then realized like, okay, then sanity came back, governments got involved and put some fuse breaks and things in place. The treasuries, the central banks came and supported the financial this thing, and the markets picked up very quickly. Within under 6 months, the market came back to where it was pre-pandemic, and it went above that as well. So sometimes markets are reacting due to greed. Sometimes it is reacting due to fear, and based on the information that is provided to the market. Yeah. So again, this is, hope you can see my screen still. This is a screen of Legal and General. It's, I think, a little bit, this is basically looking at a longer period from October 2013 to 11th October 2021. So if you look at the performance of the Legal and General stock, you can see like most of the time it has been trading between these two blue lines. Can you see like the lowest point has been 226 within this bracket, and the highest has been 276. So between 2013 to October 2021, sorry, between October 2013 to October 2021, within these last few years, let's say 5-6 years, no, it's more than that. So between that time, the stock has moved many times above 275, and many times it has traded below £2.26. Sorry if I said 276, I meant 276 pence. So the stock, actual Legal and General stock is within the range of £2.26 or £2.25 for convenience and £2.75. So someone could think, okay, what I should do is I'll buy every time the stock goes below 225, and I will sell every time it goes above £2.75. Sorry if I've confused you with these pennies and pounds. So if every time the price goes below £2.25, you buy, and if the price goes above £2.75, I would sell. And again, during this period in 2016, you can see the price has gone below £2.25. So that's an opportunity to buy. And then whenever it goes above £2.75, you sell. So if you can repeat this, one would feel like you can become a millionaire just doing that. However, it's not as simple as that, and I will tell why that is. If I go to the original this thing, I don't want to now do it because like every time I do it, I have to change the screen sharing settings. But if you, at your own pace, if you look at the performance of Legal and General, sometimes for longer periods, it has been lower than this. It's gone down this way. And there have been sometimes it has been going up. And we can't continuously assume that this will be in this range all the time. This is from 2013 to that's about 7-8 years. The market has been within that range, but there is no guarantee that it will be always like that. So it's a bit difficult to adopt a simplified system like this. So occasionally we have to veer away from that and do something slightly different. Yeah? So I'll get on to that in a sec. So far, do we have any questions? If you have any questions, please unmute and ask that question, because we will be getting into a bit technical stuff after this.
So Sanjay, you said it's not simple as kind of buying and selling at the right appropriate level, right? Why not actually? Because if you set up some like a threshold mark, can you trigger the sale or a purchase depending on those threshold levels, and then automatically, accumulate funds, increase your funds?
Yeah, I mean, there are some stocks that you can do that, but not always does a stock behave in that same format. Let's just test it out. Let me just try and see like whether I can get to a different screen. So this is like the actual period. So you can see if you go back this way. See, if you were doing that in 2009, like from somewhere, sorry, can you see my screen? Yeah.
Yes.
So if you adopted that scenario in 2009, the stock, when it hit somewhere here in 2009, you would have bought, and then you would have sold immediately when it hit somewhere around here. Yeah. Because that's the range you are expecting it to be. But then it has kept going up since then, right? And then the period I was looking at started somewhere from 2000 2013, the stock has just been going sideways. And sometimes stock has fluctuated really, I mean, drastically. This was exceptional. But
Yeah.
now we don't know what will happen from here. Like, I mean, in this stock, it might be, as long as it's going sideways, you can do that. Always you can use a Bollinger range when it is stocks going up. And a lot of people are doing that. But what I'm saying is, it's not as simple, because sometimes you will sell at the wrong time because your price indicator has been hit, and you will not be getting an opportunity to buy because the stock has acted different to what your normal anticipating.
Yes.
Is that okay, Terence?
Yeah. Got it. Yeah.
All what I'm saying is, you can do it in most shares if you know the behavior of the shares, but it won't be a foolproof method over a long period of time. That's all it is. Yeah.
Okay. Thanks.
And
can I make a quick comment? I think Sanjay is absolutely right. It could rise after that, but you can always sell and take the profit and run. So you won't lose, Terence.
Yes.
You can follow this sort of method and take your profit, and then wait for another opportunity to buy. But you would have missed out on the price, which would have kept rising, as it did in the early days.
Yes. Yeah. Would you consider like a Legal and General as a good investment, because it looks like fluctuating, but over time it's not going up. Actually, it's always within a certain two bands. So why should I? It's supposed to be going up, but in this case, it's just fluctuating between two levels. So is it a good? Would you say it's a good behavior, or is it a bad behavior in terms of investment?
When a stock goes sideways, it's indicating the market is in trepidation. They don't know which direction to take. The market is not confident in what the company's management is doing. My person, though this is not personal finance advice, like I would be very hesitant with a stock which is going sideways for a long time, because you don't know which way it will go. The next point can be low or high. So it's very difficult to anticipate the growth of a company. I am personally a value investor, and I like stock that has a fluctuating movement, but with an upward trajectory. Growth, because I don't want to trade. These are good opportunities when the market is going up and down. Rather, it's good opportunity for people who are trading. But it will become a little bit more clear where I'm going with this when we look at like how we are going to value a stock, and I'll get to that now. Ceylon Shop, and they sell Sri Lankan goods. Revenue for the company is revenue for the company last year was £100,000. How much would you pay for this business if you have to buy this company? You can unmute and give me a few numbers if you like to. But meanwhile, what I'm trying to say is, like, there is a notion, if you're buying a company or we are valuing a company, we are basically buying the future cash flows of that company in present value terms. So if that is a notion that we are sort of entertaining, how much do you think like we will pay to buy this company? I've seen few unmutes, so do you want to make few guesses?
Well, the revenue is 100,000. That's one way of looking at it. The other is to see what the profits are for cash flow, and then maybe 4 times that.
Well spotted, Ron. When I mean revenue, I should have actually been more clear. I mean profit, net revenue.
Okay. Profit. Okay. Yeah.
So any further presentations, if I use earnings or earnings or revenue or profit, net profit. All what I'm meaning is just the net after interest and amortizations and all that. Like what is the profit that we have achieved? So in this case, if Sri Lanka Ceylon shop is getting net earnings of 100,000, how much you do that? Yeah, that's very good analysis, Ron, anyway, because yeah, when we are looking at a company or a shop or a business, we should not look at just their revenue number. We should be considering their profit. Yeah.
Is it 4 times or 10 times of the, I mean, usually, what's the figure value of a company?
It can be 4 times. It can be
It's
10
an art.
times. It depends
an
on
art.
the market. But roughly, but what do you think? Like, would you pay for Ceylon shop? So let's imagine this is like Ceylon Spa or something like that, and we have 100,000 pounds profit. How much would we think like is a reasonable value if you are to value this company?
Right. I would say if I'm selling it, I would want 10 times and get out with £1 million. I would have, if I was buying it, I would pay, the best deal would be four times and end up somewhere around 6. But as Terence asked the question, to me, it's an art unless we can see there is a science to it.
Yeah, that's true.
What
That's
is
what-
valuable
yeah.
is the perception. I mean, it's the 100 to getting the 100,000 out into my private account is the shareholders in idea. So if I'm buying the whole company as one shareholder, I would like to buy it for 400,000, if not premium beyond that of 500 or 600. But I suppose the owners will want to sell it for 10 times.
Yeah.
But
Get $1 million.
aren't we missing out something important here? Because we are purely looking at, in layman's language, the net profits,
Yeah.
100,000. But there could be some valuable property and know-how and all sorts of other assets.
Yeah. Based on, absolutely. Based on what we see on the screen, that's what I would say. Yeah.
But
Yeah, absolutely.
it depends on a number of other factors as well. The market capitalization, what it's worth. As Mervyn pointed out, what is the competition for this business? Are there many people in the market doing the same thing?
Yeah.
What is the future projection? What does the company feel that the future is? So there are so many factors which would come into play.
And also the workforce.
Yeah.
What is the burden of employees?
Yeah, absolutely. Like there can be quite a lot of things. Really valid points, let's say as well, like the employee, because some organizations, the team, the people, the labor is the most important value adding factor of it. So there are many factors, and if we are generally assessing a company, there'll be a lot more information than this available to us. But if you are screening, initially looking at a shop to buy, and if somebody says like 100,000 is the revenue that is being that the company earned last year. When I mean earn, it means like the profit was 100,000. Then would you pay 2 million for this company? I'm seeing a lot of nods the other way around indicating no. So
based on what we are seeing on the screen, no.
No.
Yeah. Okay.
You need a lot more information before deciding.
Yeah. If I say like, okay, I am the owner of Ceylon shop, and I say like, okay, I want 800,000 pounds for it. Would you buy?
I would ask you for a lot more financial information.
No, if I mean on a basic level, if this is the level, would you think like 800,000 is a sensible number? You feel like I mean, normally 10 times the revenue is like the market valuation. It's going for 8 times or 800,000. Would you consider that to be a bargain and start looking a little bit deeper? I think
But-
most
Yeah,
of the time you
yeah.
would. Yeah. So it will look at. So I mean, basically, this is I think Terence and some others asked me initially, like some time ago in previous sessions, like how do we know like which companies to look at and what are the stocks that we should consider. This is like getting into it in a very surface level, giving you some indications as to what you can be looking at. I'll basically I'm touching upon like DCF or discount cash flow analysis, or this how to discount a cash flow. So basically, if we say like 100,000 is like if this is a spreadsheet I have done, I can share this spreadsheet with you all when I'm just sharing this document. So basically, if I put 1 to about 100 years, like I would assume Ceylon shop would be going into, I mean, it will be a going concern over 30, 40 years. So if it is over 30, 40 years and beyond, and I have to evaluate whether this 100,000 that I received, don't forget I said like 100,000 earnings was last year. So I need to be confident that I would get another 100,000 next year as well, and another 100,000 year after. And then third, fourth, fifth onwards. And I need to work out like what are these inflows worth in today's terms. So in order to do that, I do a small calculation called DCF calculation, or I use a discounted factor. What a discounted factor is basically 1 divided by 1 plus R to the power of T, is where R is the interest rate and T is time. So basically T is these numbers here going further, and then R is the DCF factor or discount factor I'm using. I'm using 6%. Some of you may ask me why I'm using 6 and not something else. Generally 5% tend to be like the threshold we have been using in the past for risk-free interest rate as such. If you have to buy long-term, like 10-year US Treasury bonds or something like that, they used to be about 5-6%. I know it's less now, but on average, they can be about 5%. So that's guaranteed. So if you buy the bonds, you will get a guaranteed interest. Whereas this is not guaranteed. You can get 100,000 this year. Next year, it might be less or more. So because we don't know what exactly it is, it's not guaranteed, it's not assured, it can fluctuate. Therefore, we are using 6%. But so this 100,000 today is not the same 100,000 in a year's time. So with this discount factor, basically 100,000 multiplied by the discount factor of 9.94336, using this discount calculation, I get a cash flow of 94,340. And the next year's discount cash flow, next year's 100,000 is worth about 89,000, and then so on and so forth. When I add all these things together, I get a present value of 1.6 million. So 1.6 million is kind of like, from a cash flow perspective, if I continue to get 100,000 every year, I would say like the business value is somewhere between 1.6 million, within a range. I can't say it without look, as you all quite correctly identified, like without considering a lot more factors, I could not look at that. But why I'm saying this and why this basic calculation is like, valuations are difficult, and in order to get to a correct valuation, you might have to do this for thousands and thousands of shares. So, and somebody asked, like Warren Buffett once, like, when you're looking at stock analysis, what do you do? There are thousands and thousands of companies. how do you analyze and find out what are the best values? So, and his advice was you can start with A's first. Yeah. So, but the thing is, when you do that, this will be a screening tool. Where like, if when you say like 1.6, just think of this as the market capitalization. So let me explain what market capitalization is. Market capitalization is the price of the stock that is being sold at today's value multiplied by the number of shares in issue. So basically, when you do that, that is how much the entire company is valued by the stock market. So all these companies, though we are buying single shares or like we are investing a sum of 10,000 or 100 pounds or 500 pounds, what we are basically buying is a small percentage of that company. But all these companies has a value when you aggregate the share price by the number of issued shares, and that is what is called the market cap. We call it the market capitalization, the value of the company. No matter what terms we use, it basically means that. And if that market capitalization is ridiculously too high, then you know like it's way too expensive. But the problem we are having as market analysts or looking at valuing a share, the biggest problems we have is, now I have below here, instead of using 100,000, I have used 10,000 as the earnings for the year. When I do that, the market valuation drops to 330 if it is 10,000 pounds instead of 100,000 at a discount rate of 3%. If it is at the same percentage, 6%, and if I get only 10,000 pounds, the price will drop from 1.6 to 166,000 pounds. Sorry, 1,666 to 166. At the same time, if I get 100,000 and different discount rates of 3%, 6%, 12%, I end up with these valuations. So 3 million, 1.6 million, or 833. So if somebody thinks like, okay, I am not guaranteed 100,000 every year, so therefore let me increase the discounting factor to 12% because it's more volatile and risk. I'm not assured that I'll continue to get 100,000. The moment I do this, if I put a DCF factor of 12%, I get 833. So do you, so you might ask me like, okay, so how does this help us value companies? Because we have seen like all these variations cause us incredibly difficulty in working out how to value a company. The only reason I'm bringing this out is to show you that valuing a business is a complex task and it requires a lot of attention and a lot of factors to be considered. Because I've gone through a bit of a technical stuff and I might have not been very clear in my assertions, please ask if you have any questions. I'll also show you the DCF factor calculation in my Excel, just so that when I share it, you will know what points to manipulate and you can get an answer. So this is Ceylon Shop, but you can change it to Amazon or like Legal and General or Gap or whatever the company, whatever the company you want to, and you can work out, or you can look at investment analysis reports and see like what yearly calculations you would get. So this goes up to many months. But what I just wanted to go back a little bit more and say, like, I have looked at it over 163 years, but what you have to notice is when it gets over sort of 150 years, the like 100,000 of income today is worth only 16 pounds. So it doesn't make a big difference as it goes further away to the years. So looking at about 30 years is good enough. But this spreadsheet, I have done it longer because basically I wanted to prove the simple calculation of dividing 100,000 by 6%. You could get to the same without doing all these DCF calculations. This is a simple calculation, basically dividing the earnings by the discount factor of 6%, 12%, or whatever. I have automated the spreadsheet, like basically if you want to change it to 12, this discount rate. Sorry, it is here I'm talking about basically the interest rate or the discount factor I want to use. If I change it to 12, you can see like I'm getting the 833 value. If I can change it to 8, and that can be changed to the percent value becomes 1.29. At the same time, if you want to change all of these 100,000 to, if you want to make it 50,000 pounds, I have linked this to that 50,000, but at the same time, if you are looking at your own analysis and you want to use, because companies don't have the same valuation, same revenue every year, you can put 50,000 year, 100,000 year, 200,000 year, because there will be a growth, and you can also assume a growth, or you can incorporate a growth factor into the rates. I won't go into, because I don't want to confuse you all too much. So therefore, I'm not going to do that. But this is a simple calculation, and this is how to bring future earnings in today's terms and see like what is like so many years to the future cash flow is worth in today's term. This is what we call the DCF, or present value calculation.
It's also important to sort of note that political, medical, pandemic, and other conditions, if they vary, those figures for the future years can go horribly wrong, like what happened with the COVID-19. Nobody expected a lot of these companies, like the airline sector, all the projected earnings have gone down radically. So those are the risks that we continue to carry when you value a business.
Sanjay, is it okay if I ask a couple of questions?
Yep, go ahead.
Yeah, I'm just trying to, this is my way of digesting the information. And now, yeah, you started off by showing the interest rate as 6%. Yeah, when the current, as we know, the market interest rates are a lot lower, but 6% is used. I believe for somebody with money looking to invest, is this the rationale to say, well, if the money I have, if I invest in bonds or something else, a secure risk-free investment, I could safely expect to get around about 6%. Therefore, before I take the risk of going to this company, I should get at least 6%. That's the reason why you use 6 as a safe benchmark. Is that correct?
Absolutely, that is spot on. Basically, that's what I would do.
Yeah.
About 5% to 6% is the minimum that I would expect from an investment. Because for me, if you think about it, it's not worth to
take the risk,
money at risk, if I don't at least get 6%. So that's kind of the de minimis threshold.
Yeah.
So if it needs to actually make sense, at least at 5-6%. But in the stock market, returns wise, I think I would want to get at least 8 to 9% minimum. Because of the risk involved, and because the thing is, like, we've talked about the investing in index funds and ETFs and things like in the past. So if you have invested in the US S&P 500 ETF, ETF, you would on average get more than 9% or 8.5% over a longer period of time.
So since when you have a safer investment giving that level of return, before you put your money into a higher risk investment, you need a very good reason showing good returns to entice you to take that risk. Yeah,
absolutely. Yeah, okay. The greater the risk you want these interest rates to be higher.
Okay. The second question is, using your formula, you went further and further into the 164 years of Aravit, just to hit home the point. So what you were getting at was to say, if this company promises to give you ongoing profit or revenue of 100,000 year after year after year, don't fall for it, because that money, the face value of it may be 100, but the buying power keeps dropping and dropping and dropping. Therefore, it's going to be, coming down rapidly. That is another reason why you need to look at it, use this sort of tools to get a better feel for it before parting with your money.
Yeah, but I am assuming that the company is going to earn 100,000 every year.
Yeah.
But future 100,000s are not going to be worth 100,000 in today's term. That's why it is being reduced to this thing.
Yeah.
And
yeah.
if you want to fluctuate, if you want a growing number of money, like if you are doing this with a actual Legal and General or Amazon company, you can get their investment analyst reports, and they would say, like, within the next 10 years, what their forecasted projected income is. You can drop those numbers there and do a DCF calculation to see like whether it's worthwhile.
Awesome. Yeah.
Okay. So I'll get to the next bit of this thing, which you might have heard. I'm touching on PE ratios, which is like another indicator that people are quite used to and have heard of. And to explain that, let me try to explain it here. So if this company's Ceylon shop is being sold for £1 million, and there is another shop which is like a Polish penny merchant or something like that, and the Polish shop is also being sold for £1 million, and the earnings is it's 50,000 for the Polish shop. Do you think, like, which one do you think is a good value company? Rather than asking you the answers, like the answers are here, I'll quickly go through it because I'm getting closer to the time. So, and before Terence goes, I want to get to a couple of ratios that I have here. So let me just quickly explain, and within our question and answer session, we can go dive more into it if we need to. So PE ratio is basically price to earnings ratio, and how it is arrived is like basically the profit per year. The price that you are paying for the company divided by the earnings that it has. So 1,000 divided by 100, you end up with a PE of 10. And in the other shop where it is like the same pound earnings that you have, you would basically need £20 for every pound that you are investing. So again, the PE of the Ceylon shop is PE of 10, and the Polish shop is PE of 20. So what is better here is a lower PE is better. So which means like you're paying less for more buck, or more earnings, you're paying less. So we will be looking at a lower PE. If you look at real companies, PEs of 10 is difficult to find. Most of the big companies tend to be like 20, 30 times. This is denoted as a ratio. So it's a rounded number, it's a multiplier number. So it's 10 times or 20 times that you look at. So a lower PE is a better number. I'll quickly look at another ratio. When comparing similar companies, another good indicator is ROA. ROA is like if these two shops had assets, or the shops had to be built, and the building cost of both of these things were £500. How much of ROA will the Ceylon shop earn, and how much of ROA will the Polish shop earn? So basically, 100,000 divided by 500,000, you have ROA or return on asset of 20%. And this one's return on assets is 10. So this is when in public companies that you have seen these ratios are provided, and then there are many other ratios. But for our initial touching, like I just wanted to go through these two only, the PE ratio and ROA. Basically, ROA means like the company has got some sum of assets, and what is that those assets earning for you? What is your profit, or the profit, what does it mean? So the higher rate that you have, higher amount of earnings the company is making out of the engaged capital, it's a good thing. The lower means it's opposite of that. It means like the assets of the company is not efficiently used. Therefore, if you have a company of a higher ROA and a lower ROA, you would prefer the higher ROA. So I mean, we are getting close to time, or we are on time.
Sanjay, sorry, can I ask a question?
Sure.
Now, when you do these valuations for buying, now if you got a property, that also has to come into the solution, what do you call equation?
Yeah.
Because normally when we do this, I mean, we normally do project PV values for all our projects, right? When we try to sell off certain like airports or ports or whatever it is. So that is also has to be taken into the equation to find out the selling value.
It is absolutely. It's
Yeah, because there's a separate
value.
PV calculation for the asset value, which is different from the way you have done for the earning values of the, what do you call the business, yeah.
This is actually like a very basic touch on PE. You can drop PEs for various elements. And also what I need to mention about PEs are like different industries have different PEs.
Yeah, that's what,
So, so some, it is quite comparable to use a PE of a airline company to all the, if you are comparing EasyJet, British Airways and Delta Airways, comparing the PE of that will make sense, but comparing British Airways PE rate with British Telecom may not be comparable, because that will have a, so industry-wise there are complications. So, but the thing is, what I'm saying is like, these are things that you can start with and build upon. Yeah. So, and so basically before getting to the questions, so what I basically wanted to say is like, this is why like where we warn against investing in individual stocks is like, it's complex. Even the professionals, even the, the smart guys I told you about, with all that energy and skills that they have, the professionalism they have, they are also using all these indicators and getting it sometimes wrong. So when that happens, like, what are the chances of what we are? I mean, there was this famous notion that was brought in, which was very insightful. If you want to beat Tiger Woods what would you do? People tend to think like, okay, he has had many Grand Slams. He has like done really well in his field. But if you want to be a great person like that, you as individuals can do it, but not in golf. That's what I wanted to basically say, is like, if you want to beat these guys, the professionals, you need to have a different strategy. And we will, with this series, we will look at different, I mean, we have talked about investing in index funds and ETFs. We are talking about like individual shares, but we are just touching on individual shares now, and we will build our knowledge upon that. And there are formulas, there are, people call them magic formulas. You set up a system where like you buy shares when the DCF rate is certain price, rather than just looking at the price of the share. You can value a stock when it hits a certain PE or when it hits a certain ROA, and then that will be a better indicator to find your exit and entry points. That's what I wanted to basically mention. This is a way to basically analyze. So what you have to understand, it's a hard task to successfully value assets in the long run. It's also difficult to estimate future earnings. Like Ceylon Shop, we looked at 100,000, but it's not guaranteed. The best factors, economic, political, environmental reasons can impact earnings, and you might not get the guarantee on income. So those can change. So there are many factors, and PE and ROA are important factors to consider when buying stocks. If you buy when stocks hit low PE and high ROA, you will be able to perform better than the market, and you can do it by wider margins. So that's one way of beating the market. And if you repeat that over a long period of time, you can really get financial freedom. So this is what I'm starting as like the financial freedom formula. So now we can get into our discussion. Because I know, like Terence, you said you need to go at 8:30. So if you have any quick questions or anything that you want.
Yeah, Sanjay. So one of the questions I have is, you when you're talking about Vanguard, you said it's good for ETF and index kind of funds because it has low kind of overheads in terms of the stuff that they ask for. But how about Hargreaves and Lansdowne, right? So you said it's good for individual stocks, and then if that is the case, and then how do you go about finding the right ones? So you said, should we be following the methods that you just described, or what's the best way to find those individual stocks or new products?
Yeah, so the best, again, it's not personal finance advice, but generally look at the companies that you're believing in. That might be a good start. Sometimes there might be companies that you have heard of, if you're in the medical profession or in your own environment, you might have come across a company that is working on a good product, or like having a good project that they are working towards. And if you have an ability to invest in those sort of companies, those will be good opportunities because you have more information than others. So sometimes you might have local companies that when you're walking about, you might come across a factory and you speak to your neighbors and or somebody working in their factory, and they talk very well about it. This is commercial insights that others are not privy to, and that will be advantage that you have. But if you're looking at general companies, what tend to happen is like you will have to have some sort of screening. You can use the PE ratios. You can look at companies above 10 PE, or you can look at PEs like lower PE ones, 10, ROAs or return on equity. So you can use some of these indicators, and there are also like web tools like Simply Wall Street, Morningstar, or these sort of websites will also provide you some screening ability. And some of the stock market tools like Freetrade, they might also be able, if you give your criteria, Hargreaves Lansdown might also be able to do that. If you put in your criteria of what sort of companies that you're looking at, if you say like, okay, your PE, you want companies with a market capitalization of this much, nothing below 20 million or something like that, or nothing above 20 million or billion or whatever that amount. So you can give those criteria in their dashboard, and then the website or the tool desktop will sort of shortlist few companies. Sometimes when you initially give the criteria, it might be still 100, 200 companies. And if you want to nail it down to a lesser number of companies that you can go a bit deeper, you increase the criteria that you are looking at, and then the numbers will come down and you can start screening some of those. So that's kind of the initial screening that you do. And that's how you should actually put or select some stocks that you should put into your watch list. And you have to study them. You have to look what their stock performance has been over a long period of time, gather information. Especially when there is this psychological thing that happens when you focus your attention to something, you start to gather more information about that particular thing, and more things will come to your reality pertaining to that particular stock that you're looking at. And that can be sometimes basic companies that you're interested in. Like, I mean, it can be companies like, this is not personal advice, but companies like what you use at home, like your dishwasher soap. I mean, most of those shampoos and soaps and things are produced by Unilever. And by Unilever is like, you can see like, okay, compared to what it has been performing the last couple of years, what is the price now? And you might think, oh, okay, it's going a bit low. Let me look at why it is low, and let me dive a little bit more into it and see like whether it's a good time to buy now. Same with AstraZeneca is like, I'm just picking numbers there. There's affiliation with them, but I'm just saying like the companies that we hear in our environment now, you just see like they make sense. Like you look at the debt situation as well. There are indicators of debt cover and things like that, dividend cover, debt cover. Because higher debt means like there is a bigger risk that the company could, because sometimes what happens is organizations will keep on innovating till they run out of ideas. And what happens is the company cannot sustain, their cash flows cannot be sustained till as much as innovation they have. So, and their cash flows causes them to go bust. Those are the dangerous companies. But if you start with more reputable long-term company, then you're much safer. Another good indicator is if you know, like we have talked about stock, these index funds. Like if you look at like what is represented in an index, and if you look at a FTSE 100, I think that one of the top companies is AstraZeneca. I think it is, yeah. The top company is AstraZeneca. And AstraZeneca is about 6% of the FTSE. Then it's Unilever, HSBC. So these are the two top companies, yeah. So that's a good indicator to see like what are the top companies. All the indexes are following them. You can start with them, get some experience, and once you have, don't invest a lot, invest a little bit and get more familiar with that, and then you can expand on with knowledge.
Thank you, Sanjay. Sorry I had to leave. So really useful.
No, that's fine. I hope it was useful.
Yeah. Thank you. Cheers. Thank you. Sure. See you, everyone. See you.